Hi guys and welcome. On this video, we're going to review the different steps you should take in order to find the right mortgage for your needs. Carefully and conscientiously look at each of the options and make sure you're paying attention to the long-term effects and not just the short-term effects. You want to find ways to keep your mortgage costs down, and that's not always going to be the easiest thing to do. 1. How long is the mortgage? First up, the loan term tells you how long your loan is going to take for you to pay it off entirely. The term of your loan is going to have an impact on everything about the loan itself. This impacts what you pay each month and how much your interest costs. If you have a longer term, you're going to have lower payments, which makes it a draw for many people. On the other hand, you're going to pay more interest if you take out a longer payment. That's because your loan takes longer to pay off, and you pay the same percentage of interest throughout the entire term. That is definitely not the type of outcome you want, right? On the other hand, a shorter term is going to give you the opportunity to have money available more quickly. You'll pay off the mortgage faster, which means you can use that money on something else that's more important. Keep in mind that your payments will be higher, and you'll still have to pay property taxes and insurance at the same time. Plus, if you pay less than 20% down, you have to pay private mortgage insurance, which adds to the cost of your payment. 2. Interest rates and types. Fixed rate loans means that the interest rate that you pay is not going to change. An adjustable rate loan means that your interest rate will change, usually specified times. Still, either of these can be a good idea for different types of homeowners. Take a look at just how the different options could work for you. There are a few reasons to opt for an adjustable rate mortgage. Some include lower interest rate to start. You'll usually get the benefit of a low introductory rate, like when you sign up for a new credit card. You get a set rate for a period of 3 to 10 years, depending on what you agree on when you sign, and then you'll get adjusted rates every 6 months to a year for the rest of the loan term. Greater flexibility. If you're planning on changes soon, like moving to a new house, you can get a great rate from the beginning of the loan and then get rid of the house before the rate starts to go up or readjust. Lower starting payment. If you don't have a whole lot of money right now, but you're expecting to be making more soon, you can use this type of loan to start with lower monthly payments, making it easier to afford. Caps available. Most adjustable mortgages have caps on just how much they can charge you as a total monthly payment and just how much your interest rate can go up in one period. Now, with a fixed rate mortgage, you're going to have some really good benefits as well. For those who have a stable job and want to stay in their house for a long time, this is generally the way you want to go. You'll have benefits like consistent payments. There's no problem with changing monthly payments because your interest rate won't change. The amount that you borrow is divided evenly amongst the number of payments in the term you agree to. Interest rate remains constant. No matter what happens with interest rates in the market, your interest rate is going to stay exactly the same. That means you won't have to worry about changes and increases. Comparison is super easy. You'll be able to compare just interest rates and closing costs, rather than having to factor in the different lengths of time between interest rate changes with adjustable mortgages. 3. Mortgage types to choose from. Once you've decided on the type of loan you want between fixed and adjustable rate mortgages, you'll also need to look at government versus conventional mortgages. Each one has benefits and drawbacks, so take a look at what you should be considering before you make a choice. Conventional mortgages. These are the standard types of mortgages that many people get through their credit union or bank. They're not insured by the federal government, but they do come in fixed and adjustable rate mortgage varieties. There are also other combinations that you can choose from. Interest only. With this type of mortgage, you only have to make payments on the interest of the mortgage for a set length of time. It is usually about 5 to 7 years, but could be any period that you and the lender agree to. For that period, you only pay the interest that accrues on the loan, not the principal. After that, you have to make payments that include the principal of the mortgage, and the total owed is divided between the months left on your term. On the positive side, interest only, keep introductory payments low, maximize tax deductions, and are great for money and short term. On the other hand, you'll pay more in interest overall. The payments increase dramatically after the intro period, and no equity included. Balloon mortgage. With this type of mortgage, you get to make set payments for a period of time, which is usually the same 5 to 7 years as the interest-only mortgage, but could be any agreed-upon amount. For those first years, you will pay a set amount every month. Then, when that term is over, you're required to pay off the remaining balance in one lump sum. On the positive side, balloon mortgage has low introductory payments, low interest rates. It's easy to qualify for, and also easy to refinance. On the other hand, the interest rates can increase dramatically. The principal is large when the full payment comes due. Financial difficulties can arise during the intro period, and the real estate market could fall, leaving you with a house worth less than you owe. Reverse mortgage. This is actually not quite a mortgage, but a home equity loan. Generally, older home owners are the ones who are eligible to get these. Here, the repayment is only needed when the actual borrower moves out of the house or dies. This is because the homeowner always keeps that title or ownership, and it never transfers back to the lender, even after the homeowner has passed away. Now, the amount that the individual can take out will vary based on age, how much the home is worth, rate of interest at the time, and other costs. In general, however, the older the person is, the more money they may be eligible for within approximately a 12-month period. If you're eligible for $100,000, you would be able to get a total of $60,000, for example. Then after the first 12 months pass, the rest of the money is able to be taken out. On the positive side, reverse mortgage gets to keep ownership of your home. There are options available for removing funds. The funds can be used to pay off the mortgage, and there is no mortgage payments while you still live in the home. On the other hand, the balance of the loan will increase over time because loan and fees accumulate. The mortgage could become due at many different points in the process, and you should always keep in mind home equity counts against the assets left behind at death. 4. Government-Insured Loans. FHA loan. The first type of government-insured loan is the FHA loan, which is insured by the Federal Housing Administration. These work well for first-time buyers because if your credit score is at least 580, you'll only need 3.5% down for your house. On the other hand, you do have to pay mortgage insurance, and now you have to pay it for the life of the loan. If you have that 580 credit score and at least 3.5% to put down on the house, you can get approved for an FHA loan. If you have 10% to put down, you can get approved with as low as a 500 credit score. Make sure you notice, however, just how much interest you'll have to pay. It increases as your score gets lower. VA loan. These are a great option for those who have served or are serving in the U.S. military. The Department of Veterans Affairs backs these loans and works with private lenders to get you into a house. All of these are backed through different companies and for different levels of individuals who serve. There are specific requirements which you can find online or through the VA to see if you qualify. The biggest benefit for those getting a VA loan is that you actually don't need a down payment at all. You can get into a house quickly and easily, and you'll be able to get a mortgage for the full price of the house instead. This can make it a lot easier for some who don't know how to get a larger sum of money ready to make that one-time payment. USDA/RHS loan. These are a little less well known, but they're backed by the United States Department of Agriculture, and it offers rural borrowers assistance in buying property. It's actually through the Rural Housing Service, and it works for those who are unable to get housing with conventional financing, but who still have some form of income coming in. They must have an income of 115% of the adjusted area median income, or below, in order to qualify for this program. Once they do, however, they may be able to get assistance in buying. On the bottom line, overall, it's important to look at each of the different options when it comes to getting a house of your own. By knowing what's out there and what's available, you're going to be better prepared for what's best for you. whether you have a large amount that you can put into a down payment or a small amount, and whether you want a fixed or adjusted rate mortgage, you can find something. You'll be able to find some great benefits through each of these programs as well. Overall, you just want to make sure you're weighing things out appropriately and that you're working on what's going to work best for you and your family in the long run, whether that's paying equally right from the start or paying a little now and a whole lot more later on. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Looking for a mortgage and not sure what's best for you? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.